So core inflation momentum. So this is what we're showing in this chart. The light blue bars are the 2015 to 2019 trend. So kind of how is this particular statistic behave pre-COVID? The gray bar is the prior month over month annualized rate of change. The blue bar is the latest month over month annualized rate of change. And then the dotted blue bar. So the first dotted bar in these charts, I got three charts here to show you, is the projected month over month annualized rate of change for the month of August. And the assumptions, how we get to that is just down there in the bottom blue. As an aside, whenever you see words in the down there in the bottom blue, particularly just definitely read them because it'll help you understand the analysis better. I do that on by design. And then the second dotted bar is what the 2 month annualized rate of change will be if the data point comes in right. So basically, what the July and August annualized rate of change would be if the model was correct in projecting the August month over month annualized rate of change. So it sounds like a mouthful, but effectively, what I'm trying to get to is what will the market see in terms of annualized inflation, core inflation momentum on this August report, in terms of trying to forecast that. So, in terms of, looking at the base case scenario, we're assuming the average rate of change from the June and July reports, the average sequential rate of change. So the month, so the basis point delta on a month over month basis in this particular time series. And so we wind up at 3.4% for trim mean CPI, 6% for median CPI, 4.4% for sticky CPI. We'll get the PCE data at the end of the month, so we'll ignore that for now. And you wind up on a 2 month annualized rate of change basis of 4.4% for trim mean CPI, 6.1% for median CPI, and 4.9% for sticky CPI. From my perspective, that's not going to cut it. That's going to be sticky. The market might read that as sticky, and at best, that's probably not a very bullish outcome. It's certainly probably not the most draconian outcome, but it's definitely not going to be something that I think is celebrated by the market. So again, base case scenario is that it's probably not going to be great, and 3,800 is probably what you should be targeting. In terms of in terms of where you would think about booking gains and covering shorts on the short side of the trade. Looking at the bull case, which assumes the same rate of change from the July report. Now, by the way, we talked about this in the macro scouting report on Tuesday, and in previous around the horn presentations. The rate of change from the July report, i.e., minus 629 basis points month over month in terms of the month over month annualized rate of change of core PC. These are historic readings in terms of the month over month, or in terms of the rate of change that we observed in July. For something like trim mean PCE inflation, that deceleration is the biggest deceleration in the history of the time series. So like there's it was a pretty historic month in terms of the breakdown in core inflation momentum in the month of July, and we talked about it at the time. Hey, this is part of the reason the market rallied and recovered. There was a legitimate fundamental reason in the direction of Goldilocks, i.e., inflation really breaking down on the core side and growth, proving resilient and actually improving sequentially across a variety of indicators. So that's how we got to 4,300, at least initially, kind of in mid-August. But anyway, so accepting the fact that the rate of change we observed in the July report is historically and very unlikely to be repeated. But let's just say it happens. So let's just say it occurs again. We're going to wind up at 0.9% for trim mean CPI on a month over month annualized rate of change basis, and then the 2 month annualized. Looking at July and August, you wind up at 3%. 3.8% month over month annualized projection for median CPI, 5% for the 2 month, and then 2.7 and 4 for sticky CPI. So that would seem to suggest that accelerated and autocorrelated is kind of the developing theme, and I think the market will take that and run with it because it'll start to anticipate that this 3 will be a 2 something in the September report. This 5 will be a 4 in the September report, and this 4 will be a 3. And then by December, this 2 could be a 1, this 4 could be a 2, and this 3 could be a 1 or a 2. The market's going to look forward and say, hey, if the Fed sees a 3 month annualized rate of change of 1 to 2 on core inflation by the end of the year, or so by the let's call it October, November, December, probably October, November CPI reports, that's going to be very positive, and the market's going to start to celebrate that. And we talked about this in the macro scouting report as well. Obviously, quantitative tightening is one thing that's going to that's really weighing on the net liquidity function. But the other thing that could offset quantitative tightening, perhaps offset it even more than I think investors realize, is this gigantic pool of excess liquidity in the reverse repo facility. That's $2.2 trillion that doesn't have to be there. It could very easily go to take duration risk or credit risk in financial markets. If investors and if the risk appetite improves, the general sentiment improves, and this is one of those things. This is the number one thing that would improve sentiment is the market adopting the view that the disinflation process is going to be accelerated and autocorrelated, i.e., inflation was in fact transitory. So that is a very legitimate market risk, and so that's why we spend so much time discussing these dynamics. But what's also a very legitimate market risk is that this process is sticky and stochastic. So, one thing we talked about in the macro scouting report, and I'll just skip ahead and come back, is it's very rare for the current magnitude of negative core inflation momentum to be sustained over the next, let's call it 1 to 3 months to 1 year. And so, what this data, what this analysis looks at, because I mentioned, I alluded to this, the July rate of change in these time series broke down. It's levels that are very rare and historic. We had a 461 basis point deceleration in the annualized rate of change of term mean CPI. There's only been one other reading in the history of that time series since going back to like the late 60s that has been bigger than that on a 1 month basis. And the next month popped 111 basis points. So there's only been 33 observations in the history of the median CPI time series where the month over month annualized rate of change decelerated by 247 basis points or more. And the median change in that 33 inside sample is 168 basis points to the upside. Same dynamic with sticky CPI. But in 29 of those observations, with a month over month annualized rate of sticky CPI broke down more greater than or equal to minus 270 basis points on an absolute basis, and 160 plus 160 basis points is the next month. And as you can see, with these with all these that have actual sample size, over the next 3 months, it's higher usually. That's the blue bar in these charts. And then even over the next 12 months, it's kind of like flattish, flat to up, you know. And then when you look at trending PCI, as I mentioned, that's the biggest. There is no N. There's N of zero. That's the biggest deceleration in trim mean PCE inflation we've ever seen in the history of that time series, which I believe goes back to February of 1977. So there is something happening in inflation that's very positive from the perspective of the Fed reaction function and the economy. So we just want to see if that positivity extends itself. And history would suggest it's very unlikely to extend itself. When you look at things like core PCE as well, again, there's only been one insize of that, but the one insize is telling you don't expect it to continue. And so going back to this chart is this assumes the median rate of change from these analysis upon these statistics, and you wind up with a month over month annualized rate of change of 6.6% in the month of August for trim mean CPI, 8% for median CPI, 7% for sticky CPI, and then in terms of the 2 month annualized rate of change for June and July, you're at 6%, 7%, 6.2%. That is the definition of sticky and stochastic. You're bouncing and it's sticking, and that's not what the market needs. That's the scenario where you still continue to get the reverse repo facility build. Obviously, Treasury General account at around 500, $600 billion is probably not going to move very much in either direction from that particular point, just based on the guidance we received from the quarterly funded announcement in June or in Q3. And so this is probably how this is a scenario where quantitative tightening really bites because again, it's not being offset by a decline in the reverse repo facility.